What is leverage and spread? Leverage involves borrowing a certain amount of money needed to invest in something. In the case of forex, that money is usually borrowed from a broker. Forex trading offers high leverage in the sense that for an initial margin requirement, a trader can build and control a huge amount of money. For example, a forex broker may offer 50-to-1 leverage, which means a $50 margin deposit would enable a trader to buy or sell $2,500 worth of currencies. Similarly, with $500, one could trade with $25,000 and so on. Whilst this sounds favourable, it's essential to remember that leverage is a double-edged sword. Without proper risk management, this high degree of leverage can lead to large losses as well as gains.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. So in just 6 months, 3 of the 5 biggest independent firms on Wall Street have now disappeared. Bear Stearns, which collapsed last spring, Lehman Brothers, and Merrill Lynch.
What brought Bear Stearns down was, I think, basically, number one, we were highly leveraged.
All forex quotes are quoted with two prices, the bid and the ask. For most part, the bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means the bid is the best available price at which you can sell to the market. The ask is the price which your broker will sell the base currency in exchange for the quote currency. This means the ask price is the best available price at which you will buy from the market. Another word for ask is the offer price. The difference between the bid and the ask price is commonly known as the spread. Effectively, it's the commission the brokers charge traders for placing their trade.